Hey everyone, Adam Bergman here, IRA Financial. Welcome to another episode of Adam Live. Thank you so much for joining me. Hope everyone's well. Hope you had a good Thanksgiving. Today I want to talk about an important and new checkbook control IRA case. And I'm going to spend some time talking about it. The facts are pretty basic. It actually is a pretty unremarkable case because it's pretty much a slam dunk win for the IRS. So I'm not sure why the taxpayer decided to pay the tax and go to tax court, because it was clearly evident based off the statute. If you look at the tax code, they were going to lose. But anyways, they decided to go to tax court to fight the penalties. And we'll talk about the opinion because it does have some, I would say, broader impact for self-directed retirement investors, specifically cryptocurrency investors who want to hold Bitcoin or other cryptos in a cold wallet. So let's start with the case. It's called Mcnulty V Commissioner. It just came out November 18th, 2021. The site is 157 Tax Court number 10, if you're interested. I've done a bunch of podcasts and Adam talks on it, dropping a blog on it. But what I want to do is just kind of go through the facts of this case briefly, and then really have some discussion about it. So let's get right to it. Just in a summary, the Mcnultys used the Self-Directed IRA LLC. So the IRA was owned by an LLC. And the LLC purchased gold, American Eagle, IRS-approved minted coins. The only problem is the coins were shipped to their home, and they held the coins in their house. And because of that, they were not successfully able to argue that they satisfied 408M of the Internal Revenue Code, which says clearly, and I'll talk to you about it, that you can't hold coins or bullion anywhere outside of a U.S. trustee, i.e. depository or a bank. So holding coins at home is just a clear violation of the statute. So let's talk about the facts. And just excuse my coughing. I've gotten 3 negative COVID tests in the last 4 days. But I just have a sinus and cough. So excuse me, I'm going to try to not cough and have a coughing attack, but bear with me. So in August 2015, Ms. Mcnulty purchased, she's the company called Checkbook IRA LLC. I think they're still around. Anyways, it seems like on their website, they said that you can do this. They said that you can purchase, at least that's the opinion says. I'm not sure if that's true, but anyways, they said that you could use an IRA LLC to buy gold or coins and hold it at home. And they weren't alone. I've done a bunch of Forbes articles on this. Over the last couple of years, there's been many instances of advertisements online, as well as on the radio and TV, from gold dealers saying they have a perfect solution that will let you buy gold and store it at home. And our industry just was up in arms because it was just lies, rubbish, very unscrupulous marketing strategies that were just clear-cut lies. So we definitely banded together to educate our clients and to educate the IRS that this is happening. You need to stop it because it circumvents the rules and it's not good for our industry. So for whatever reason, this company was allowing you or telling people that you can use Self-Directed IRA LLC and hold the coins at home. They used a trust company called Kingdom Trust, which probably didn't even know what was going on because all they were doing was funding the LLC, right? They're not responsible for what the LLC was doing. So once they sent the money from their retirement accounts to Kingdom Trust funded this LLC, which is called Green Hill Holdings LLC, and they were filed in Rhode Island. It was a Rhode Island LLC. And then what happened is the Miss Mcnulty, she was appointed the manager with her husband of these LLCs. And what happened next is then once the cash came from Kingdom Trust to the LLC bank account, at that point they used those funds to buy coins from Mills Franklin, and the invoices showed that the LLC was the purchaser, so that was okay. However, and this is the big problem, the shipping labels identified Miss Mcnulty individually or along with her IRA as the recipient of the shipments. And then the problem is the coins were shipped to her home and not to a bank or depository. So that ended up being the problem with the case, or with the Mcnulty fact pattern, because that violates 408M. So she spent a lot of money. She put $375,000 into her LLC to buy these American Eagle coins, and she purchased 320 1-ounce American Eagle gold coins, and then at that point the coins were held at her home. She then did another investment. She did some real estate and did some more coins, and the same process was followed, where the coins were held at her home. The custodian, Kingdom Trust, did what they were supposed to do. They filed 5498s. The value was provided by the client. But the unfortunate part is that the Mcnultys sent the gold to their home and held the coins in a safe in their home. So let me read the tax code. Before we get into what this means, let's talk about the code. So I'm just going to read from the code. So under 408M, 408M talks about certain transactions that are not permitted in an IRA or 401k. Collectibles, life insurance. There's an exception for 401ks. So within the exception portion for collectibles, it talks about, for purposes of this subsection, the term collectible shall not include, and it goes through all the gold coins, and then it says any gold, silver, palladium, or palladium bullion, and then it goes, if such bullion is in the physical possession of a trustee described in subsection A of this section. So basically what they're saying is that if you buy IRS-approved bullion, coins, bars, they need to be held in the physical possession of a U.S. trustee. What some people, again, I think taking a very aggressive position, were saying, listen, the physical possession requirement only applies to the bullion bars. It doesn't apply to the coins, because the way the provision is drafted, and I do agree, the provision is not drafted very clear. It should have just said all bullion or coins in the physical possession, but it just says bullion. Because if you look at section 408M 13A, it talks about any coins, and then B talks about gold, silver, and platinum, palladium, bullion, and then the physical possession is right under subsection B and not subsection A. So some people said, well, clearly they wanted the physical possession to only apply to bars and not coins, so here we have a workaround that we can allow you to hold coins at home. But the intent, clearly, when this provision was drafted back in 1974, was for the government to have more knowledge of where people hold their gold, and the idea is they wanted the gold held somewhere where there's an accounting of that gold. So it's highly unlikely, and legislative history suggests in this case is clear, that the intent was that the physical possession would apply to coins as well as bullion. So for that reason, just based off that statute, the case is pretty unremarkable, right? Nothing really interesting occurred. The facts weren't really in dispute. She clearly violated the statute. Should have been 3-4 page opinion. But interesting enough, when the court wrote this opinion, they didn't even start with this argument. They started with a different argument. And the first argument was based off control. And they talked about, and I'm going to quote from the case because there's some very interesting quotes in here. And let me get to them. So it says here, independent oversight by a third-party fiduciary to track and monitor investment activities is one of the key aspects of the statutory scheme. When coins or bullion are in the physical possession of an IRA owner, whatever capacity the owner may be acting, there is no independent oversight that could prevent the owner from invading her retirement funds. This lack of oversight is clearly inconsistent with the statutory scheme. And this is key. Personal control over the IRA assets by the IRA owner is against the very nature of an IRA. And the court focused on term control. And it basically stated that any personal control over IRA assets could trigger a taxable distribution. Now, before we get into what control means, in most instances, when you do real estate, hedge funds, private equity, investment fund, private businesses, tax liens, those types of investments, even cryptocurrencies held at an exchange, with your IRA, you don't really have a personal possession or unfettered control or unfettered command issue. Why? Because courts have been very clear on this matter. For example, the Mcnulty V Commissioner case held that no taxable distribution occurred when the IRA owner personally received a check that he could not negotiate. The funds were then used to acquire stock, and the stock certificates were issued in the IRA's name. In another case, the Mcnulty V Commissioner case, the court held that no taxable distribution occurred if a stock certificate was in the IRA owner's possession, but it was issued in the IRA's name. Okay, so based on Bergman and Sierra, if you have a real estate deed, a note, subscription document, stock certificate, you're not going to be deemed to be control or be in the physical possession of that IRA asset. But gold is different, right? It's tangible. You can move gold anywhere you want, right? Coins smaller than this baseball. So it's not like real estate. You can have a deed to real estate or a stock certificate to a company. It doesn't give you unfettered control over that company. You can't go to Domino's and take the stock certificate and buy a slice of pizza, right? Gold, you could. Cryptocurrencies, you could too, right? Cryptocurrencies are a digital gold, right? It's not tangible, but it's transferable, negotiable. So if you hold cryptocurrencies on an exchange, so if you go through IRA Financial, excuse me again, and you buy Bitcoin or Ethereum or other cryptos, and you hold them on the Gemini exchange, you're good, right? The account's in the name of the IRA. You have no possession over that IRA. The keys are held at the exchange. You can trade, just like you can buy or sell stock, but you don't have personal possession of that crypto. The crypto is on the exchange. But what happens if you want to take the cryptos off the exchange? What happens if you want to hold them in a cold wallet, kind of like a nano, right? Why do people want to do that? For added security. You can put a nano, take it off the internet, so it's cold, and you can put it in a safe, and you have much more security. So there are a number of cryptocurrency investors, even in the IRA world, excuse me, that want to hold cryptos off an exchange. Now, before the Mcnulty case, there really wasn't any precedence on control or physical possession, especially when it came to cryptos, right? Gold was really the only tangible IRA-owned asset that you can actually physically possess. The Ansira and the McGraw cases were clear that if you hold stock certificates or a subscription doc, or indeed you weren't actually possessing that IRA asset. So there really wasn't an issue. But the Mcnulty case now, and unfortunately it's the risks of going to court, is that the court will write an opinion. Sometimes the opinion may not have ultimately the language you desire, not just losing the case, but also as precedent for future taxpayers. And in this case, it seems that the court used the opportunity to expand the definition of control and talk about unfettered command, unfettered control, personal possession. So they didn't mention cryptos anywhere in this case, or digital asset, Bitcoin, crypto. It's not in this case. This is a gold coin case, right? And it's a slam dunk case because it, just violated the statute. It was clear, really a no-brainer. But the court, again, I don't know what their intent was. I don't know if they had the concept of cryptos in their back of their mind. But if you take these themes and if you take this line of argument and you apply it to cryptos, then yes, if you moved your Bitcoin off Gemini to a cold wallet that you now hold in your pocket, do you have unfettered control? Yeah, you got the keys, right? Do you have unfettered command of that crypto? Yeah. Do you have personal possession of it? Yeah. It's an IRA-owned asset. We got a problem, right? So this is something that, IRA Financial we're on. We've been working with our our blockchain and our crypto tech people to come up with a solution. We're working on something that we hope to have finalized in the coming days. Essentially, it's just going to be a dual signature wallet where we'll have veto signatory authority as well as you will on the cold wallet. You'll still be able to have a cold wallet. We can't take the cryptos without your consent, and you're going to need our consent to move the cryptos. And again, it's not something I want to do, but I think to satisfy the Mcnulty case, we need to show the IRS that you do not have unfettered control over your cryptos. And if you're holding them in the cold wallet, without IRA Financial having a veto or some signatory authority over that wallet, if you get audited, the IRS easily could just point to Mcnulty and say, you lose. You have possession of this asset. It's thus taxable. So we obviously don't want that to happen. And this is something that we're working on. We allowed our clients prior to Mcnulty to move them off the Gemini exchange into a cold wallet. Again, it was tied to the IRA account. You had to acknowledge that you understand the prohibited transaction rules, and you would not move these assets in any way or use them for any personal purposes. But since November 18th, the Mcnulty case, now we need to take additional steps and really show conclusively that you have no unfettered control or command over the IRA asset. So overall, again, the case wasn't very remarkable. I probably wouldn't even do a podcast on it if it wasn't for the opinion and it wasn't for the court's focus on command and personal possession. So if you have a self-directed IRA without the LLC, nothing to worry about, except if you're pulling off the cryptos to a cold wallet. Excuse me. If you have an IRA LLC, you need to be cautious if you're doing cryptos. If you're doing real estate, private notes, private investments, you're not going to have that unfettered control issue because, excuse me, again, you're not going to be in possession, and you can always focus and turn to the McGraw or the Ansira case to show no personal possession. So there you go. I don't want to die on today's Adam Live, so I think I'm going to kind of just stop now. But I did an Adam talks on this, kind of some similar ideas, but really overall, don't freak out. Checkbook control is here to stay. It's not going anywhere. If you're not doing cryptos in a cold wallet, you don't have to worry about anything. But if you are doing cryptos in a cold wallet, work with us, IRA Financial. We'll have a solution through a dual signatory wallet where you'll be able to hold those cryptos in a cold wallet and not violate the Mcnulty case. Tom, I'll try to get to your question. I'm sorry. Horrible cough. To be clear, you don't know for sure what you're planning on implement will survive a challenge on unfair control, right? No, I'm pretty confident that if, in the case states, if there's no unfettered control, meaning the custodian has veto power to that asset, meaning you can't move it without the custodian, then there's no unfettered control. So there's no issue. So what that means is you'll need to get IRA Financial's consent if you want to move the cryptos to a DEX or to move it to a different exchange. You'd have to get our consent. We can't move the cryptos without you, but you're not going to be able to move them without us. Truthfully, Tom, not something I want to do, but I don't want my clients to have taxable distributions on their cold wallet crypto. So the case is kind of forcing our hand on this one. If I already moved cryptos to a cold wallet, what should I do now? I would consider moving it back to the exchange just now, just till we have some more guidance. Because now that Mcnulty's out, again, this case just came out a couple weeks ago, we want to be proactive. So I would suggest if you have cryptos in a cold wallet, put it back on the exchange for now. We'll have a solution in the coming days. If you want to employ it, where there'll just be dual signature required on the wallet. Not much we can do. The case is out. It's too bad. It really it's just not much we can do. Honestly, it seems kind of unfair, but I understand it, right? The IRS just doesn't want you to have so much control where you can do whatever you want with that asset. In the case of a real estate deed, it's not an issue, right? You can't go to Saks Fifth Avenue to buy a pair of shoes with a deed from your property, but you could with Bitcoin, you could potentially with gold, I guess, right? So it's easily transferable, and they want to put limits on that. So that's the reason for it. Thank you. I feel a little better. At least I don't have COVID, but just have this nasty cough. So we'll have a solution in mind. For most IRA crypto investors, they keep it on the exchange. So in this case, we'll have no, really not much importance to them. But obviously, don't hold coins at home. If you have a checkbook control IRA LLC, our operating agreements are clear that you should seek the consent of the custodian before making investments. And the reason for that is this, right? We want to show that the IRA custodian still has some part of the process and there's not unfettered control. So we'll be sending around, if you're a client of IRA Financial, documentation on this. We'll probably update our operating agreement too as well, to just make it super clear and focus on the fact that there's an independent review of these transactions. And that's why, honestly, we have our annual compliance fee. Most people pay it. We have probably about 92% of our clients pay it. Some don't want to pay it. It's only $199 a year. Why it's there is that if you get audited, you can show the IRS that, hey, I have a transaction reviewer. I need to go through that person each time I make an investment. I do not have unfettered command or unfettered control of the IRA LLC assets. Trust me, it will help on an audit. So I try to explain to some people. Some people just do not want to pay the $199. I said, okay, it's your money. You can do whatever you want. But this is why it's there. Okay, it's there. So technically, you come to us each time you make an investment, and it's there to show the IRS that whether you're going on our app to fill out a prohibited transaction questionnaire, you're contacting us to get a consent to do an investment, it's showing that the custodian has a direct connection to that investment, and there's no unfettered command by the taxpayer over that IRA LLC asset. But overall, if you take anything away from this case, take two things away. One, don't hold coins at home in an IRA. Use a depository. Two, only if you have cryptos in a cold wallet, you should consider putting them back on the exchange at this point until we have a solution with a dual signature type cold wallet that will allow us to show that you do not have unfettered control or command over those cryptos. So again, excuse me, I'm going to end it now. Next week, I promise I'll be better. I'm going to rest up. But thanks for watching. It's an important case, Mcnulty V Commissioner. And be well, take care, and talk to everyone again next week.